Well, good morning. Welcome to Financial Friday. My name is Matthew Atkins, and as you can see, I've got my friend and guest here, Ben Selleck, who is the founder of Clearbrook Investment Management, and it's a privilege to have him on today again. We started the conversation last week. We're hopefully going to drill down a little bit this week into some of the things we touched on last week. So welcome, Ben. Good to have you on again.
Good to be on, Matt. Thanks for having me.
Looks like you're in your hunting cabin again.
I am, yes.
Sitting there in that same place. Did you move since the last time?
No, I've been sitting here since last Friday.
Yeah. That's a long time to be sitting there, I'll tell you what. But it looks like a good environment, so hopefully it's been relaxing.
It is nice.
Yeah, good. So one of the things we talked about last week was about the valuation of the markets. We hit another top again on Friday. The S&P, the broader market, seems to be coming off a little bit today on trade war news. We talked about that a little bit too last week. So it just seems to be bouncing right up against that ceiling right now. So you and I have talked quite a bit about kind of the current valuation of the U.S. stock markets and where we see them in the scope of history. So maybe you could talk about that a little bit. And then I want to read this quote from Ben Inker from this podcast that you sent me a little while ago, which is really interesting. So maybe you can touch on kind of current valuations and how they fit in the overall scheme of long-term kind of market performance and where we've been in the past.
Sure. Well, looking at the U.S. market, the S&P 500, for example, traditional valuation metrics are near all-time highs. We hit highs, in 1929, in the year 2000. We never quite got this high in 2008, but we're very high historically on valuations, and some of that might be justified because we have very low interest rates. So that's definitely one of the reasons that we have higher valuations, is that stocks are priced to return less than historically they have, and part of that reason is because bond rates and interest rates are so low that they're priced to deliver less than expected. So it's understandable in some ways why we're priced so high. One of the reasons that one of the kind of alarming things is that everything in my mind has to kind of go perfect from here for us to have pretty decent sort of reasonable returns. We have the profit margins in the stock market, which are if we have a company sells a product and then they have expenses and they get the bottom and how much do they keep? That percentage of what they keep is near all-time highs. And so historically, that's kind of been when someone sees someone else making lots of money, very high profit margins, they move in and compete. And if profit margins get too low, companies go out of business. And so it's kind of a mean reverting, historically been a mean reverting metric. So we're already at all-time highs, near all-time highs for profit margins. So we've been able to squeeze some earnings out of increasing our profit margins, but those are high. Sales are pretty slow growing in the United States. We're not seeing top line sales grow that fast. And so really things that have to, either profit margins have to continue on past our all-time highs here for us to see the kind of earnings growth that we've seen in the past, or sales have to pick up much higher than historical numbers. So you put all the perspective and to say the stock market has a high valuation. Part of that is justified because interest rates are so low, but it's really priced for perfection here in the United States, and that's a little worrisome.
Yeah. So when you say it's understandable somewhat because interest rates are low, that's because with such low interest rates, there's more risk appetite, right? That people are driving that valuation up.
Right. If you can get, say, 2% in a long-term government bond, and you look at the stock market and say, wow, I can get 6%, I'll buy that. And eventually the stock market returns get bid up to the point where future returns look like 3%. Think, gosh, I'm getting 2% in the government bonds or 3% in the stock market. At this point, I'm indifferent. I'm not saying that's the exact valuations, but when the alternatives don't look as good, prices are usually bid up to the point where future returns are lower to kind of compensate for, if we could get a U.S. Treasury bond rate at 10%, everyone will be selling their stocks and buying U.S. Treasury bonds. But because interest rates are so low, that stocks have been priced to deliver lower future returns.
Yeah, so that the appetite for some return certainly drives the valuation higher. It's very similar in some ways to the housing market, and people start to be afraid they're going to miss out on the growth in the market or maybe miss out on their dream home. And so they go out and pay a high price, even though as an investment, it may not be a very good investment for them.
Right, exactly. We have different reasons for buying homes rather than just pure
Yeah.
investment. So you see some funky pricing there. But the same thing as when you're buying a yield. I mean, we've seen home prices go up. The same sort of phenomenon. Interest rates are low, so housing prices are going up, driving down investors' returns. If you're buying in a home as an investment or commercial property, those returns are lower because interest rates are lower. People can borrow cheaper. Alternatives don't look as good. It's kind of this. They've heard it. They talk about an asset bubble all across the United States because of these low interest rates. So we're seeing asset prices being inflated to the point where future returns are far below historical norms.
Yeah, yeah. Um, I mentioned that podcast that you sent a little while ago, really interesting, quite long, so a lot of people didn't listen all the way through. But the guest from GMO was Ben Anker, and he had this to say about kind of because the valuations are so high here, then in the domestic markets, then looking at some other places where there might be lower valuations, better opportunity for future returns. And he says, I get excited at times like this when I don't have to imagine good things happening to the assets I like in order to get good returns out of them. He went on to say about the US markets, is it possible to get good things out of them? Sure. But we're going to get good returns if surprisingly good things happen. So I'd much rather be invested in a place where even if bad things happen, I will get a good return. Very interesting comment.
Yeah, I love that comment. It speaks to the, really the market. Future returns are somewhat about expectations. Are expectations going to be better or worse than they are now? I think most people can look at, and say, okay, the U.S. economy is probably still going to be decent for the long haul. We're going to go through a recession at some point, but that's really not the point when you're investing. The point is what's priced into the stock market. So when you're looking at international, some countries that are going through some tough times, their stock markets are priced for terrible things. And so if you buy stocks in those markets and terrible things don't happen, only kind of bad things, then you can have pretty good returns because the stock market's already priced in terrible things. So I just mentioned a moment ago, for the United States, a lot of ways the pricing is priced for perfection. So if really good things happen in the United States, we'll probably have average returns, average historical returns. Whereas you look somewhere like, let's just say, Russia, that market's priced for some pretty terrible things. So if they just have a mediocre economy, mediocre returns, you could see that stock market really skyrocket. I'm not saying buy Russia. That's still, you have to take risk into account, your goals, that sort of thing. But it's really about what is the expectation in the market, and are the earnings of those stocks going to beat those expectations or not? So when you have low expectations, it's much easier to clear those hurdles.
Yeah. So when I'd like to talk about that a little bit more, but I'd like to touch on, particularly about kind of investing in foreign markets, emerging markets, and where that opportunity is. We're probably going to have to split this up and do it in a second session. But when we look forward earnings and forward opportunity in the domestic markets, a lot of people are just thinking in terms of U.S. stocks, U.S. bonds. Kind of, what do we anticipate its price to return if you were to buy in today, let's say, in the next 8, 10, 12 years?
You're talking about U.S. stocks now?
Yeah, U.S. stocks.
Best estimates I've seen are anywhere from around, 0% a year to 4% a year over the next, say, decade, maybe 5% a year, historical returns going forward.
That's not going to be a straight line. It's going to be a
jagged, but yeah, you could lose 50%, then make a bunch of money the next couple of years, and you still average whatever, a low average. So I think the way, unless something drastically changes in our economy for the better, as far as, I'm talking versus the last 50 years, even better. I mean, historical, amazing, better. Most likely the stock market is priced for those low single-digit returns.
Yeah, I think I mentioned to you that I was on a webinar last week with Robert Shiller, who's, obviously Nobel laureate, Yale professor, really well known for his CAPE index. And he made an interesting comparison in terms of kind of the risk appetite that's out there. He talked about how for the last 100 years, real estate really has only grown about on average 2% a year. And most of us would never put up with that in terms of our stock investments, and yet we keep doing it in home investments. And obviously that's because a house for most of us is way more than an investment. As a matter of fact, you might say it's not an investment at all. It's a purchase for other reasons. But when thinking in terms of kind of the investment opportunity, it just becomes really important to consider, because we're differentiating between buying a home and actually having investments, to consider what that forward return opportunity is, and where to look for that forward return. So if you don't mind, Ben, I'd like to kind of wrap this up to keep it a little bit shorter, and then come back and talk for the next week with you about opportunities that we can see in other places.
Sounds good.
Okay, good. Well, thank you for tuning in. Obviously, you can contact us. Our information will be down below. We'd love to talk with you further about what we see in the U.S. markets. Maybe you have a portfolio out there that you'd like evaluated, and so we'd be happy to do that for you as well. Otherwise, have a great weekend, and we'll look forward to talking to you next week.